let me just hand over controls to Dr. Rashid Bhatti, um, and I'll quickly just unmute him, and we can do a quick test of his audio. Dr. Rashid, can you hear me?
Yes, I can hear you. Assalamu alaikum, everyone. Thank you very much for joining to this first of our LearnIt webinar series. It has been it is a matter of a great honor and pleasure to talk to you guys all and connect with you via virtual mechanism that we are employing. Before I just go ahead and start, I want to make sure that everyone can see my screen well. And there's no interruption. Okay, so during the talk, please do not unmute yourself because this is going to just start reverbing. So so I would just give you chance to ask your question toward end. If you want to say something, say it via chat, and Ali is going to be looking at the chat messages throughout. And Ali, I would let you moderate and read the questions, and please go ahead and at the end of the when we have a Q&A session, please just say the question in the mic so that it gets recorded, and I will try my best to answer that. So having said that, I would just straight jump into it. And first thing I have to say before I just go into it, I am no expert on stock marketing or stock market or trading. I'm just sharing my experience and my journey through this whole thing. Whatever I have learned, I would just try to share my knowledge. I'm primarily a scientist, not stock market or expert. So this is just my personal experience that I just started. So my journey started in 2004 or 5 time frame when I was still in my grad school. And I'm going to just save the story for later if the question is asked about it. But just to having said that, stock investment is not an easy thing to work. There's a lot of risk, and all the time when you're just investing your real hard-earned money, there's always a risk that you lose it. So I think I just take it as a love-hate relationship. So, and I just look at it as a cycle that goes on, and sometimes it works, sometimes it does not. So what happened is that, somebody just encourages you that, hey, you know what, you can make a lot of money in the stock market. You invest some money in there, I mean, based on your capacity and your ability to take the risk, and you make some money out of that. And what happens is that, suddenly greed takes over, and you then start pouring in more money in there. And when you're not ready for that, or you just do it prematurely, what happens is that you get a loss. Sometimes people lose a lot of money in that cycle, and you say that, okay, you know what, I am not going to do this thing ever again. This is not my cup of tea. So you just, and then you meet yet another friend of yours, and she says that, you know what, it's not so hard. I can tell you that, there's so many things that you can just do with it, and you can just manage your risk, and you can just maximize your gain, and blah blah blah. And then you go in there again, and the cycle goes on. So it's not something that but once you just go in this cycle, you just keep going in there, and at some point you become an expert, and then you start skipping from all these greed, loss, and then just you start stabilizing yourself. So my objective here in this talk is to try to share my knowledge and explain to you that how you can avoid this whole cycle, and then get so getting started. So it's typically, if you Google, getting started is just simply opening your account with one of the brokerage provider, and then put some seed money in there and start trading. But I would say no, don't do that. Don't do that. That's like the typical I would say framing mechanism they just put on and you get in there. So I would strongly recommend educate yourself. And the longer you educate yourself, the better you understand things, the higher chances are that you will survive the whole thing. I'm actually dividing this into like 4 sections. So just we'll just try to see if we can just divide this thing in equal timing, but let's see how we go about it. Okay, the first thing, opening your brokerage account. I mean, of course, the question comes that, where do I open the account? So I I tried my best not to answer those questions which are like can easily be Googled. But you know what? Toward the end, I realized that everything that you want to know about this whole stock market and trading, pretty much everything is there in the Google. So you can just go Google it, and Google is going to bring you like all kinds of information there. It's like if you're a good reader. But if you're like lazy reader like myself, you tend to listen into the videos or tutorials. That is not something that's like available like a shortage. You can just find tons and tons of videos, tutorials, and so suit yourself, pick one of those brokerage accounts, open them, and I would say that do not just jump in there. Just put some reasonable amount of money that you can think that if it is lost, I would just consider this one as my uh, experiment money, and it's fine. I will be able uh, to sustain that loss. So there are like typically 3 kinds of accounts you can open. Regular cash account, that means that you will put your money in there, and that's once it is transferred into your brokerage account, it will be available to you for immediate transactions trading. Margin account is like a little bit more risky account where it actually allows you to trade more than cash that you actually own, and that is like is a little bit risky. So there are implications. I would say if you're going for that, do study it. What all are the possible pitfalls in there? Don't just jump into it. So if you're a beginner, I would strongly recommend start with the cash account. And then the riskiest one that I tend to play with more often is the option account. So on this slide, anything that is there is like also available on the link below that I shared. So nothing secret that I'm sharing here. So next is to get yourself done. So like you have to have an investment strategy. The thing is that you have to make sure that you know that what you're trying to do here. You want to set it up as your regular income or supplement your income, or you have some spare money lying around that you would like to grow. So that is like a one that you have to just be clear in your objective, because sometimes when we just keep going in there, those lines between your objectives start becoming blurry, and you tend to just start when you read reviews, or you talk to people, or you just go on some WhatsApp channels and then listen people doing some funny kind of transactions, and you just tend to just lose track of what you originally wanted to do with your investment. Then comes the long-term versus short-term investments. Long-term investment can go from anywhere from like few months to few years. That means that you pick up some security or some ETFs that you think that, okay, you know what, I'm going to dump my money in there. I'm going to go to sleep for 6 months, or you will just like once in a while you'll just check the stock, or you read the news. Hey, the stock market is going really low. You just stick your money in there, and then you just wait or just go to sleep. Don't worry that if the markets start tanking further, don't worry. It's going to, the market always takes correction, always go back. So if you find times like this, jump in, invest it, and then just forget it. So that's a long-term investment. It's like least painful in a way that uh, you don't see it every day. But this is like a human instinct. Once you just put your money in there, you just start looking at the stock news and stock performance every day, which is like a very bad overall for your health and for overall your life, because then it starts becoming a part of your life. Compared to that, if you're like you doing it like a more often short-term investments, the short-term investments can go from few days to few weeks or max a month or so. So that's a short-term investment. And there's a more like I would say more advanced version of stock investment trading is called day trading, where you actually just trade in like you just buy things in the morning, and just in a couple of hours you sell it again, you buy it again, you sell it again, and you just keep buying, selling all day long, sitting in front of a computer, watching the stocks going up, going down, going up, going down. That is like, it's like I would say like don't go there. It's a very common human tendency that once we invest in the market, we just keep seeing the stock over and over and over again, and it's just like and every time it's like going like few cents down, few cents up, and you just start like getting your blood burning. So don't do that. The next thing is the transaction type. So typical stock market trading is you buy stocks and then you sell them. That's like, so that means that you can only make money when the market is going low to high. Whereas you must have heard a lot of time from people saying that, hey, you know what, you can actually make money when the market is going down. And that is where the concept of short or sell means that you can just sell or short. And how that works is that you can actually sell before you even buy. So that means that the first case is very simple. You just buy cheaper, and when it becomes more expensive, you sell it. So low price, you buy at low price, you sell it high price. Whereas when the market is going down, what you can do is that you can actually sell it. And when you want to sell it, what happens is that the first step, you actually borrow it from your broker, and broker actually lets you borrow that, and then you immediately sell that in the market. So that means your account, say suppose that you just shorted say Apple stocks, like 1,000 stocks, say, you would borrow it from your broker. They would let you do that, and you will immediately sell it in the market. And what happens is that your account would show negative 1,000 stocks, or say maybe 100. So negative 100 stocks. So that means that you would not be able to realize the gain or profit out of that until you settle down by buying those stocks back, and then that will just complete this transaction, and that's how you would be able to make money. So now, having said that, since we are going through a bearish market these days, we can do this, try of this short. That means that you can just short sell something that you anticipate that is going to go down, and you can later buy it back at a lower price and then settle the transaction, and that's how you make the money. Okay, so next thing is the investment evaluation and thought process. So that means that what should be the underlying thought process that when you're planning to pick where you would like to invest. So I strongly suggest that do not just do not just follow your friends, or someone told you that, hey, just buy it, that's wonderful something. That's like a very common pitfall, that when you just see that some channel, some people are saying that buy this one, buy that one, do understand what it is. What are you trying to do? So pick companies, not stock. That means just go read the summary statistics of their portfolio. What is their typical 52 weeks range, and what is their profit earning ratios, and create a list of your favorite stock. That is absolutely important, because uh, you should not just like go on, because there are about like 200, about 3,000 active stocks, and they're like, if you just look into the full list of the tickers out there in the New York Stock Exchange, there are about 6,000. So you do not want to just go and fish around in every one of those. You should make sure that you know where you're investing. So there are some companies which are like multi-billion dollar market cap companies. They're very stable. You can just, and their stock is very expensive, and it's very difficult to actually make money out of those. So a typical tendency is that you just go for the cheaper stocks. When you just go for the cheaper stock, so now you have to understand that now you're putting your money at risk by just going for a company that can collapse completely, and then your money can be gone. Um, and one thing is very, very important, that you should not put all your money in just into uh, one type of stock. You should just diversify it. Uh, there are like different segments of the industry that you can just invest that. But before you go there, I again just cannot just emphasize more on that you have to understand the underlying business and the industry segment where you want to invest. So that's the list on the left. I would say that's a more of a static one-time deal. That means that when you're just going through your basic process, just get yourself lined up. Okay, you know what? I like these stocks. These stocks are good, and you have to document your reasoning that why you are just picking them up. Once you have done that, then there's something that is like your more, like I would say, day-to-day behavior or dynamic behavior. And your dynamic behavior should be check your emotions. The moment you're about to do the buying or selling, just make sure that what you're doing, plan ahead for panicky times like these that you're seeing these days. But remember this thing: market always corrects itself and comes back. So no ebb or flow is forever. There's always cycles. And build up your stock positions with a minimum of risk. I would just say that try not to go for risky stocks. Try not to take some risky positions, because you know that when you take risky positions, yes, you do uh, have a chance to get more profit, but there's a higher chance that you lose everything. One more thing that I have to just mention at this point, that you have to keep in mind that what you are pitching yourself against. There are multi-billion dollar companies out there who are just doing all this stock trading electronically, and they are doing it on rule basis, and they're like artificial intelligence is going on. They're just doing all sort of uh, analysis electronically, and you guys are like doing it all manually. So I would just say that make sure that you understand what you're pitching yourself against. Yes, the last one is very important. Overactivity. No, don't do that. So uh, this is like strictly, I would say, or mostly be avoidable. Okay, so let's look into a quick guided tour how to actually look for some stock. So money. So I'm just like, there are tons of, like, if you Google around, you'll just see that a lot of stock evaluation and performance tools out there, and comparison tools out there. So what I'm going to do is I'm going to pick up one of these, and then we're going to go to Yahoo Finance, and then we can just pick one of these. So typically you can use the stocks work with their tickers. I think that much you probably know already. So if I just pick this one, Apple, this will give us, so now you can just look at these numbers, and you can just look at the market capitalization. What is their profit earning ratio, and their 52. So these are the numbers that you're looking at. So compared to that, if you just look for some other company, so like GE, look at that. So this one is much smaller company compared to the Apple. So now immediately the point comes in your mind that, what if I want to compare these two? So, and side by side. So there are some tools here that you can compare things side by side. So you can just simply say, AAPL. If this actually lets me do that, or here, AAPL, and then say GE. Compare symbol. So now you can see that how this thing is like telling you that where it is opening, where it is closing. So if you look at this thing, this stock Apple is like way too expensive. And you remember this thing, that your profit, it's like going to be measured in percentage. So if you look at this thing, what is the high to low ratio here, and what is the high to low ratio here? So those ratios are going to be determining your profit range as well. Overall, you can just compare these stats here. If you go further down, there are some more. You see that market cap? These are the number that actually tells you how stable is your investment, how stable is the company where you're just investing. So going back, there are other things that other tools out there like MarketBeat. This is another one. I'm pretty sure that this is yet another one. It's very easy. They tried to just grab your email, but you can probably use a different browser to just go without it. So, okay, so I would stop here, and